Welcome back, everyone, to Vox Markets Live. My name is Paul Hill, and I'm delighted again to be able to speak to equity analyst and stock markets commentator Paul Scott. And I understand, Paul, big congrats. It's your first anniversary of your Substack. So we're getting that champagne out.
Well, I've just opened a tin of Carlsberg. So cheers, everyone. And thanks for an amazing first year of my Substack. So, it's thrilling.
Well, I was going to... Yeah, well, I think from the audience, I mean, I've been subscribing for a whole year, and I can tell you, thanks very much for your service. I mean, Jesus, I've never known anybody to produce so much output every single day. It's absolutely vital for my morning, sort of like, pep up to get me going in the day. It's absolutely perfect. So, big tip to the hat, and hopefully you'll be going on to for the next 30, 40 years. So, that'd be brilliant.
Yeah, I've got a great team now as well. It's four of us all working our guts out for everyone, but we love doing it. So sorry, I'll let you get on. Sorry.
Yeah, well, it's another celebration actually, because it's Guy Fawkes Day today. We've had lots of fireworks on the market. So have you been sort of using any of the recent volatility to buy or sell anything over the past week?
Not really. I mean, I have topped up some of my, whether I'm doing this right or wrong, I don't know yet, only time will tell. I have topped up my problem position in Spectra Systems, SPSY. Every time I look at the fundamentals on it, I just don't get why the valuation is where it is. So I have added to that one. I know they say don't average down, but I don't. I think selectively I do. I've top sliced a few of my things that have sort of gone to sleep. So Shire Therapeutics, is it? I think it's Therapeutics, Shire. Anyway,
Shield.
That was it. Yeah, I've sold about half of them. It's still a decent sized position, but I think I was a little bit overweight in it, and it's kind of gone to sleep a bit. So that provided some money to top up Spectra, and also Beeks Financial Cloud seems to have come alive again. So so just tinkering around the edges with a few positions, really. How about you? You done anything?
I've been silent this time. As I say, last week I bought my. I'm fully loaded in stocks and shares, so I haven't got any spare capital anyway. But that's
you burned through your cash pile then.
Yeah, no, absolutely. Yeah. Well, it wasn't difficult. Let's be clear about it. It's nearly always fully loaded into equities. Anyway, we've had lots of questions, particularly on the M&A front. Let's start with Harry. Let's finish off Treatt, that flavors and fragrances business, because we've been talking about it a lot. And just as a recap for everybody, it's had a bid from private equity, which has now been rejected by its biggest shareholder, Dola, who's also a trade buyer. So it was a 290 bid, rejected by Dola. What's your take on what Harry's asking? What's your take on what you would do, or what you think about doing in terms of going forward with the business, in whether it's a sell, a hold, or a buy?
Well, I was talking to the readers on my Substack, and also my sort of network of investing friends, and the mood seemed to be very negative about it, and people were expecting the shares to fall to £2. I think that you and I had the same conversation, didn't we? We were sort of people with generally thinking that they might fall to about £2 on the failure of the bid being announced. But I was thinking, well, I don't think the market thinks the bid's going to go through anyway. And certainly when Dola topped up again and went to 28% quite recently, it was quite clear that they were blocking the bid. And so I think the market, when it was announced a couple of days ago that the bid had fallen through, I think that was already in the price, and the market has barely flinched. So I think that's quite encouraging. I'm actually starting to feel a bit more positive about this. We know it's underperforming. We know it's a 2-year turnaround. Not 100% convinced the management are necessarily the right team to be running it, but that's for other people to decide. So I think it's quite interesting. To me, the fundamental thing is that who was it? Was it Exponent? I can't remember. Maybe that's the wrong.
Yeah, Exponent is the guy, but it's Natara are the real bidders, really.
The real bidder. Yeah, they're backed by Exponent, aren't they? Yeah. So the fact that they were prepared to pay £2.90. Which means they think it's worth a lot more. And the fact that Dola paid up to £3.10 to block the 290 bid, well, that's pointing towards this thing having at least longer term considerable value, more than the current share price of £2.30 something. So I think if people are patient, this could turn out quite well longer term. But I think, and Dola have hoovered up 28% of the company. So that's been plenty, you would have thought, for stale bulls to have got out. So I think at some point this glass could turn half full and not half empty. So it's not cheap enough for me to want to buy. In fact, it's not cheap at all on current earnings.
It's 17 and a half times PE.
Yeah, but the fact that it's turned round a bull and that two significant industry players think it's worth a good bit more than the current price, I think that is actually quite, for people who are patient, I think that could be quite encouraging, actually. And maybe it's got another profit warning in it. I don't know. Over to you then, Paul. What do you think?
Yeah, I'm with you. If you've got a sort of like a fairly medium-term time frame, you could do very well at it. Who knows what happens now? Okay, but I would suspect with 28% of the shares, I'd be stunned if Durla decides not to replace the board and put its own people on the board.
Ah, good point.
So you're gonna get them, and I'm sure there's quite a few institutions who are a bit disgruntled as well. So I'll be stunned if we don't see changes on the board. And I think you're probably right. I think it's going to get worse before it gets better in terms of the trading. Now, that has a positive and a negative effect. One, it'll lead to changes and improvements, and they'll be able to certainly sharpen the culture and that commercial team they have there to start winning deals. However, because if they have a profit warning, then Durla at 28 can't buy any more shares. So who's going to be the marginal buyer, having already had a rejected bid? So I think the shares on a profit warning, because Durla can't add unless they're going to go over 30%, and they'd have to, if they do that, they're going to have to go. The minimum bid they can do is 305, which is the past one they did the last 12 months. So I think. You'll see short-term weakness in it. You'll see management change. I think the shares will probably fall on the short-term weakness as some of the institutions finally just said, I've had enough. But at some point in time, if Durla's right, that's because they've got 28% of the shares, and they think this is savable, this business. It only trades at 1.1 times sales, and so and that's because the margins are so small. So if it does 10% plus EBIT margins, I could see this go for 1.5 times sales, which would be like £3.50 ultimately. But you're looking over a 2-year period, because I think there's going to be quite a bit of change associated with it.
I think that's a very good synopsis. I mean, we're guessing to a certain extent, aren't we? But, a marginal buyer who's hoovered up 28% of the company in a short period of time will have taken out an awful lot of stale bulls. Yeah. That's my view. So I don't know how many stale bulls are left. I think we covered all the angles on that, haven't we? We'll just have to wait and see.
All right, another M&A deal. We got Philly's asking about the cheeky bid from Brave Bison for M&C Saatchi's performance media assets of £50 million, which I think was only at about something like 6.3 times EBITDA, which was a really low ball offer. What's your take on it on terms of, is the value really, I suppose, in M&C Saatchi, and whether Brave Bison would deepen their pockets to come out with a bigger number, maybe?
Possibly. I mean, I think somebody needs to take Brave Bison management to one side and say that if you want to buy something, you've got to agree.
Again, isn't it?
You can't. It's like my next door's Range Rover. My neighbour's Range Rover is beautiful. He just paid 40 grand for it. I don't walk up to him and say, "I'll give you 23k for it." Deal. It's ridiculous. Yeah. So I don't know what they're playing at, but there could be stuff behind the scenes, couldn't there? There could be institutions who've said to them, "Put in a cheeky bid. Let's shake things up a bit." So we don't really know the full story, but I mean, it doesn't particularly highlight value in M&C Saatchi because they weren't paying anywhere near a premium price, were they? So, we think Saatchi shares are interesting for sure. And it's not a distressed seller. That's the other thing. Saatchi's balance sheet is fine. So it's not like they did something similar. Brave Bison did something similar with the Mission Group, didn't they? Where they tried to sort of muscle that. This seems to be their strategy. Just go in like a bull in a china shop and see what happens. Yeah. I mean, good luck to them. I think Brave Bison, they're clearly very ambitious, want to get on with things. Yeah. The shares have done very well. It was one of my top 20 for this year, actually. So I'm more or less 100% up on that, I think. So, I do admire Brave Bison and what they're doing. But the shares, I think for now, probably need to consolidate for a bit. Over to you, Paul.
Yeah, well, you say that it doesn't sort of like indicate this hidden value in M&C Saatchi, and I would say there may well be, because I know we just agreed it's a cheeky bid at 6.3 times EBITDA, but if you look at the metrics on Saatchi, it only trades at less than 4 times currently EBITDA.
Oh, interesting.
And it's got a very good issues division in there, which does that sort of like the marketing for the global, sort of like aid relief programs around the world, which is their crown jewel. So I would say, actually, if anything, that it underpins the valuation on Saatchi, because at 4 times EBITDA, and it was a cheeky bid at 6.3. It sounds to me there must be something hidden in there. It seems too low. Saatchi does, that's for sure.
Yeah, I think that's a good point, actually. There was a supportive broker note out on the day of the news as well. It might have been Pam Muir's, but it is available on Research Tree, that said something similar, said basically this does highlight, but there again, they're saying the performance division is the sort of crown jewels within Saatchi, so you'd expect it to be on a higher. Yeah, we think Saatchi is very interesting, and I must admit, although it did warn on profits, didn't it, that long ago, but I don't think it was too bad. I think this sector may be quite interesting, actually, for people prepared to take a bit of a risk for a cyclical recovery. And Saatchi's done a lot better in previous recessions than I would have imagined. And I think it's for the reason you say, that they've got some of these very specialist divisions that are kind of not reliant on cyclical stuff. They do stuff for governments and whatnot, which I believe is quite lucrative. So yeah, Saatchi looks interesting to me, and on a PE of less than 10, I think that could be. Look at the chart as well. It tends to move in this sideways range, and it's near the bottom of that range now. So yeah, not a bad share to have a look at.
Yeah, well, we've got tons of M&A. We've got another one. Okay, Simon's asking about what's your latest on TT Electronics, having just got that bid from I think it's a Swiss player, it's an electronics group. It's Secor or something, and they've been blocked by DBay. Anyway, it seems like a rerun of Treatt here. But what's your take on this one, and whether you should stick or twist on it?
Well, only people have got to decide that for themselves. But I think it was a good offer, I have to say. It's 100p cash, I think, and another 55p in Secor shares. Well, I checked up on it. It's a Swiss listed company. And it's about $1 billion market cap. It's had a tremendously impressive share price rise. Secor has. I think it's not like you're being offered toilet paper, for the 1/3 in the shares element. It's simple enough to just arrange with your broker to sell some listed Swiss shares if you don't want the shares in due course. You could even front run it and short them. So I think this is a very good offer, and I would be. There's a chance. DBay have said they're not going to support it, but they haven't got a stake that's big enough to definitely block it if there's a big majority of other shareholders who want it. Could DBay come in with a higher bid? Because TTG then disclosed that DBay itself had put in 3 cash offers up to £1.30. And there was a lovely statement from TTG, wasn't there? Beautifully worded, saying, we think DBay might have slightly different agenda to other shareholders, or something like that. I thought that was beautifully put. So it's a live situation. I have to say, if it was me, I'd probably bank the profits in the market now. But people have got to make, and it's not binary. We can always just sell half, can't we, if we're in a bid situation? So come on then, Paul. What would you do?
Well, okay. I mean, basically at 150, it trades at about 12 times PE. Okay, admittedly, it's got quite a bit of debt. It's only 6 times EBITDA. Now, if we cast our mind back about 12 months, 18 months, didn't Volex put a cheeky bid in as well for this one? Now, I would not be surprised, given this is only £1 of cash and then 55p of share capital. I would not be surprised if Mr. Rothschild out in and the exec chairman of Volex has a really, really good look at this now, because DBay was very low at 130 and their private equity, and they never pay top dollar. Secor have taken the opportunity to, as it's in play, and if Volex and Nat Rothschild have any interest in this business, this is the moment to pounce. And given he's got a fantastic reputation at Volex, it wouldn't be unheard of him to actually open his pockets and buy this, given he's shown interest. And if he does that, it will certainly be higher than it'll be all cash for nothing else, and probably a higher bid. So I would, if I was owning them, I would actually be patient on this one, because I think there's too many interested parties who could play some cards on this.
Yeah, and that's an interesting angle on it, Paul. Can we remember what the latest trading at TTG was like? Because it did have some problems, didn't it?
It was not good. Put it this way: the management probably needs to be changed out, which is why I think Secor and anybody else would be. But
mind you, checking my notes here, Paul, on my other computer, on the 24th of September, TTG put out its H1 results. We concluded, doesn't sound confident, but expects full year in line.
Yeah.
There was a material uncertainty on going concern, which you don't want to see. Debt was a bit high, but we concluded it does seem to be making some progress. So I would say this is not a fire sale as such, but TTG clearly needs, I think, it would be better off if someone else bought it with more stable finances, wouldn't it? So very interesting, and well done to anyone holding it. They took a risk buying a share with a material uncertainty, but that's sometimes where the big percentage gains come, isn't it, with the riskier situations.
Yeah. Okay, we've got the next one on the old M&A. We've got Jane. She's asking about Audioboom, the sort of podcast expert that's had rumours on the market from Sky News that they've had numerous bidders, and then they've made a formal statement that they're going to do a strategic review. What's your sort of what's your sort of thoughts on this one? Whether this is going to go through? There's nothing certain, nothing sort of like to get your teeth into yet. But the shares are definitely on the up. The shares represent that there's going to be a bid, actually.
Yeah, exactly. I mean, I have no strong view either way on this. We've reported on it numerous times this year, where we just present the bull arguments and the bear arguments. 8 times this year we've covered it. It's just it has been quite a good turnaround. I think it's fundamentally not a very good business. It's okay, nothing special. It's an advertising business, really, sells advertising into podcasts, quite low margins, but performance has been improving. So I think you can just argue either way. I think the bulls, several of them have contacted me privately and just said, look, Paul, if you look at the advisors, they've got one American advisory group, and any buyer is almost certainly going to be American, isn't it? And of course, we're in a big tech boom at the moment. They might well put a lofty valuation on it. So it could go either way. For me, it's just there's too much guesswork involved. So I'm not interested in just making guesses about who somebody might or may not pay a premium for it, because, like I say, it's just guessing, isn't it? But good luck to holders. And I am, I fully understand the bull and the bear arguments on it. So
isn't the CEO? I think he's the founder, isn't he? And he's very passionate about the business. I mean, my instinct is that it's got to be a knockout bid to actually take this off the market, which is why I think people are anticipating. Am I just reading the guy wrong? I thought he's not just a hired hand. He's somebody he sounds really sort of like into this business of his own passion, his own.
I read it the other way, actually.
Did you?
Paul.
Okay.
Yeah. I mean, this again is guesswork, but the strategic review seemed to me to be saying, actually, we've lost interest in this, and we want to either scale it up big time and make some substantial acquisitions, or we just want to sell it, or we just want to sell bits of it. If you read the terms of the strategic review, to me it was just saying, look, we'll consider anything, which says to me they can't be that confident about continuing on a standalone basis. Do you know what I mean? So, but it's entirely whatever interpretation you put on it. Looking at the shares, I see there's Mark Horrocks with 5.5%. Is that the founder?
I don't know.
Chairman. Here we are. Michael Tobin, the chairman's got 5% as well. There's several other individuals. So collectively, you're right. Actually, collectively, the directors have all got. That looks like it's about 15-20% maybe for the directors. So I wasn't aware of that, actually. So that's interesting. Yeah.
Okay.
So what do you think will happen, Paul? I don't think you've chipped in with your views on it, really.
Yeah, I think this could go either way, actually, and move the dial quite a lot. I could see the shares moving up and down by £2. If they get a bid or knockout, then I'll accept it. But it's got to be a big number. It's sort of £8-9, I think. And then but if they don't get that, it ain't going anywhere, and it's coming down because I don't think the business is in that good a place to generate those type of numbers to justify a valuation of where it currently lies. But but I don't know which way it's going to go because it is the number 5, I think, podcast producer in the US. So it does have its scalability. So it'd be total conjecture. I wouldn't want to bet either way, to be perfectly honest, on this one.
Yeah, I'm in the same. I like to go on things where risk reward is firmly skewed in my favor, rather than just totally guessing, which I think is what we're being asked to do here. So not for me, but I really hope holders do well on it. We need people to start making some money to fire up this market. So good luck to everyone who has punted on it.
Yeah. Okay, good. Let's move. We've got Nikki's asking about the merger or the combination in student accommodation in the UK of Unite and the buying Empiric. And it looks as though basically it's a defensive play because both shares are going down on this merger, which just seems it isn't generating any shareholder value at all. It's going down, going the other way. What's your take?
Well, I was puzzled by this, I have to say. I looked at both shares in tandem this week. I think it was, there was an update. So Empiric gave a trading update, didn't it? And it was slightly below. They said they were slightly below expectations in terms of the bookings. And I think you actually foresaw this or spotted it when I didn't. There does seem to be an issue with Chinese students, and amazingly, Empiric, obviously it rents, little studio apartments, what we used to call halls of residence, really, to students in the UK. And 43% is domestic UK students, and demand is rising for that. 30% is Chinese student. The whole of the rest of the world is 27%. So the Chinese are bigger than the whole of the rest of the world put together, which is extraordinary, isn't it? And of course, any sort of tensions geopolitically could be very bad news for them. What happens if China does go ahead and invade Taiwan? I mean, this China risk seems very significant here, and I wonder if that's what the market is looking at. But you're at a really big discount to NAV now. And we've discussed before the potential alternative use for some of these blocks, where part of it could be rather than sublet to students, could be sublet to just temporary workers, single people. So I don't know, and I think it does look quite attractive to me, actually, as maybe a slightly distressed type of situation. But I think the loan to value is reasonable. So there's no balance sheet. Yeah, I think these are worth a look for sort of special situations. Investors could be quite interesting. But I'd be looking at buying Unite, not Empiric. I recalculated the Empiric bid because it's cash in part in shares, and it's adjusted to the share price has adjusted to roughly what the bid is worth. So the market seems to be assuming the Empiric bid by Unite will still go ahead. That's what the share price is telling us. Yeah.
It looks like a defensive consolidation play to me. I think you've obviously got that Chinese exposure, but the other big problem for the whole of the industry in the UK is that there's too much supply. There's too many student accommodation. And I think Empiric said that in terms of Nottingham and Sheffield and Glasgow.
Oh, that was it. It was 3 specific towns, though, Paul, cities. They said the rest of the UK, there's not oversupply. So I thought that was, sorry, I just remembered that.
Yeah, it isn't just 3. They're the worst. I mean, and then the vacancies dropping like a bomb. Unfortunately, or increasing a lot, and the actual occupancy is dropping through.
Yeah, I think it was 89% at the moment, and it was 95% last year, wasn't it? So it has. It's not terrible, and they apparently they get a lot of bookings. I think they said in January. Is that right?
Yeah, they do. That's for the postgraduates.
Right. Yeah, the occupancy is down though. I'm not disputing that. Yeah, you're right.
No, I mean it smells to me because I mean these things they're net tangible assets. I mean you've got the Empiric is trading at about 50% discount, or no, it's about a third discount, and I think
Unite's higher.
it's about 40% or something
That's
like
right.
that. So then, so the big discounts. However, what that is saying is that the net tangible assets are calculated on a capitalization rate, what yield you can get from the actual buildings. And you only need a small change in your vacancy rate or your occupancy rate, negatively wise, to make a big difference in the valuation of the property. So the market sniffed this one out, saying that actually they're going to have to, because there's so much supply, they're going to have to take stuff out, and therefore it's going to reduce value. So I personally think it's a value trap, and I would not go until we see the bottom of this supply, unless we start rebalancing that supply demand equation. I think occupancy levels are going to be under pressure for a long time, actually.
You could be right, Paul. I mean, I wouldn't go as far as calling it a value trap myself. But I think when you see a sort of discount of 50 odd percent, or almost 45, 50% on a REIT, it's the market saying, look, there's going to have to be write-downs on the book value of these properties. And we are actually seeing that with some REITs. You've seen some quite savage write-downs in, where they've got occupancy issues. You have seen in other REITs quite big write-downs to NAV. So yeah, I think that makes sense. Some of the discount is justified, but maybe not all of it. And you have got on Unite, you've got a 6.8% dividend yield.
Yeah,
and I think they did say as well that rents are going up. I think so. Value trap's a bit strong, but I take your points.
Okay, let's last one on the M&A. We've got Tina. She's asking about Next 15, which has been the troubled sort of marketing company that apparently has had some rumored interest again from Sky, from private equity, to put a bid on them, and the shares have responded. How do you see this one?
Well, it caused something like a 10% intraday spike, didn't it? Up to about from £4 to £4.40 odd. And it came straight back down again, literally within about half an hour, which is quite interesting. It was something I didn't initially spot, but I then spotted the next day. The Sky articles put a figure on it and said that some private equity operator was looking at buying £230 million worth of subsidiaries of Next 15, which is over half the market cap. It does have quite a lot of debt, though. So this looks like, if it's true, and I mean, there's usually Sky just seems to be the go-to source for leaking information, doesn't it? And it's usually fairly reliable. It looks interesting. I mean, the shares have recovered very, very well in the last year. Obviously, it's been quite troubled. Considerably troubled, Next 15 has. So personally, for me, the trade has been and gone. I'm not interested in chasing it up. And quite a bit of the disposal money would be to pay down debt, I think. So I don't see a particular opportunity there right now. But one of the groups they were looking at disposing is MHP Communications, who of course have been very helpful to private investors. We deal with them a lot. They give us access to companies. So and a shout out to Reg at MHP Communications. He's been a good friend over the years to private investors. So I hope whoever owns them ends up being a safe pair of hands as well. So could be interesting. Have you looked at it lately, Paul?
Yeah, I mean, I've spoken to a number of fund managers who own it, who are holding it even through the tough times, because they believe there's a lot of hidden value. But I haven't yet really done a sum of the parts on it, which I think you need. I mean, just looking at optically, it trades at about 5.5 times EBITDA. Now, if you just use a benchmark of 6.5 is a cheeky bid, which was the one from Brave Bison, then actually it's still non-expensive, but it has got a lot of moving parts in terms of, basically their balance sheet, and whether they also need to pay some contingent consideration for the previous acquisition, that Mac something or 50, I can't remember, Mac 69, was it? There was
49, I think.
49, yeah. It was what I can't remember. It was a company they bought anyway, which went south, and they might still have to pay some.
I think they're disputing that.
I'm not surprised. They should do, because it really took them down.
Yeah, it did. That was quite a scandal, actually. That was back in May and June, wasn't it? Yeah. With two profit warnings. So it has been a bit of a mess this year, but the market seems to have looked through that. And as you say, that does suggest, doesn't it, that there's hidden value in there. So interesting.
Good. Okay, we've got Casper Mann. He's asking about Water Intelligence, which came out with a Q3 trading update today. Very, very positive, actually. Double-digit top-line growth, and I think it was 50% on a Q3 of PBT and EBITDA growth. So, what was your take on Water Intelligence?
Well, hello to Caspar Man. He's one of my my top subscribers, very supportive. So nice to hear from you. I just advise him to read our article today because he's a premium subscriber. We've written up a section on water intelligence. It was in line actually. Yes, Q3 trading update in line with expectations. It says PBT up 23%. It looks cheap. We think water intelligence does. It's the PE is only about 9, rather slightly weak balance sheet, but not alarmingly so. And do look at the cash flow statements for these, because about half of the cash generation is spent capitalizing development costs, I believe, and then the rest goes on acquisitions, buying back franchises. We can't get above amber on it personally, just because it's got a slightly strange history. There's slightly weird cross shareholdings linked to the executive chairman, some corporate governance issues. So we're not really sure on this, but optically it certainly looks cheap for sure. So you hold, don't you, Paul? I think
I own it. I own it. Yeah, I mean, I've had it for about 2 or 3 years. I'm absolutely delighted because if you look at it, they split out the Q3 numbers and they did top line growth of over double digits. They've done profit growth of about, if you just go further down that RNS, you get 50% increase in like sort of like EBITDA and PBT. And basically, and the reason for that is because the profit, they're seeing more on the top line because they're really energizing their franchisees using this Dallas template, which is their best franchisor, or they own it. They're rolling this out to the rest of their business, which is, and they're putting new technical products in, so things like the Streamlabs, wireless monitoring, preventative maintenance, and this is effectively energizing all of those franchisees to increase the top line, and therefore you're seeing double digit. Not surprisingly, it's then coming through operating leverage as they take out costs, and you saw that from the Dallas model. They've reduced costs by 1 or 2%. Now, 1 or 2% on a top line of about nearly $100 million is a big chunk of change, which will be coming down. And you could tell by their announcement, they're very positive on how this is going to exit 2025 into 2026. And if I was a betting man, I've seen this one before. I think they're going to have a really strong 2026, and they're going to get a series of upgrades. So I'm delighted by the numbers. And the only reason why I think the shares haven't gone up as much, I understand there is an institution who's been forced through redemptions to sell some shares. Okay, so what? And I love this situation because I had exactly the same with Equals back in 2020 because I was trying to build a position in Equals, and I had an institution selling to me, and I just thought, fantastic. I just mopped it up because Crystal Amber basically at the time for Equals had 25% and wanted to reduce it, and they sold out all the way up, which just meant that institutions and myself, we just loaded up on it, and we ended up going out. We bought at about 30p, and ended up going out at 140. So I mean, it was, and I think this will be the same, to be perfectly honest, because if you've got liquidity, you've got somebody who's selling, and you want to get in. If you like the story, then this is the time to do it because you can get liquidity. Definitely. Because there's a forced seller in the market, and that's why you're seeing. I mean, the shares are trading at less than 1 times PEG ratio. They're trading at less than 1 times sales, and these guys will do basically over 20% EBITDA margins, which will drop down into about 15% EBIT margins, and they're going to carry on driving the top line, double digits. And the CEO Patrick D'Souza, he basically said that all the upside from the wireless monitoring from the Streamlabs is not in the broker numbers for 2026. So if they get anything from that, and he reckons he can double the top line over 5 years by using those, because it's just all it is upselling. It's using a platform and more selling into the same customer base. So no, I was delighted, and I was not surprised the shares have only popped up 5% today, because there's institution who I believe has got an overhang. But anyway, all I think that's
sorry, go on, Paul.
Yeah, all I would say is that if you're interested in a sort of like an infrastructure water preservation type of stock, then this one is very cheap, and it's actually reached an inflection point and a turning point, in my opinion. And disclosure, I own the shares, so I'm bullish on it. Okay, but I think this one could do very well next year. I could be wrong, but I think it will.
No, I think we're seeing increasing numbers of shares like this, where you can actually, they've disappointed somewhat. I mean, the long-term track record on water, if you look at this, zoom out to the sort of 15-year chart on Water Intelligence, it's dreadful. It's gone all the way up and almost all the way back down again. But, if, like you say, if you can then look at that, you've got forced selling essentially by, which is still a big issue in some shares. And that is giving you a lovely opportunity. We're seeing lots of these at the moment where good news just gets sold into, and you're paying a PE of 9 at, like you say, what could be an inflection point. Risk reward, I think, looks pretty good on that. And they did, but it was only in line today. Let's be fair, keep a bit of a lid on the excitement. But it did say, as you said, increasingly confident, in inverted commas. But the forecasts from Canaccord were unchanged today, so it wasn't an ahead of expectations. But like you say, I think there's some evidence that it might beat these forecasts. So I think it looks quite interesting. Yeah.
Okay, just give you an indication, because they're still in line for this year. Okay, they're in line. What they need in Q4 is $3.1 million. Okay, to do EBITDA 3.1. Just remember 3.1. They did in Q3 4.7. They did in Q2 5.4, and even in the quiet month, in the first quarter, they very quiet one. They did 3.8. What is the betting? What is the betting? They beat the 3.1, and then you look at the sort of the EBIT. They'll have an exit run rate of this year, in my view, opinion, of probably 5 million average EBITDA per quarter, and the consensus is at 18.5 even at the moment, and that's without any more momentum. So I'll just say, I would say those estimates are conservative unless something happens. But anyway,
that's the right way to do it. I wish more companies would do that. You just pitch the forecast a bit below what you think you can comfortably achieve, and then we get that. Then you get that nice ratchet up, don't you? There's too many companies who do it the other way around, I'm afraid.
Yeah. Okay, good. Let's move to. We've got Drew. He's asking about Zotefoams, which is a very popular share.
It is.
Backed by Cottony Rebel. In fact, I think he's got 25% of his portfolio in this one. He obviously believes it. So they came out with Q3 results, I think, and they did see a slight slowdown from a very good first half, where I think they had sort of stock building ahead of the tariffs and new product launches with Nike, and then they had a slight decline in Q3. But anyway, the shares were savagely sold off on the back of it, even it was all in line. What was your take?
Well, we've been very positive on Zotefoams now for several years, actually. We always said, look, this is an each way bet. You've got a core business that's doing well, a specialized niche business with decent margins, and we had the kicker in for free, which was the resource project. Now, unfortunately, as we know, the resource project was binned at the end of last year. Shares then really significantly oversold, but we stayed green on it, which is our top rating throughout, because we said, look, this is a really good business. So it's great to see Cottony Rebel get involved as well sometime later. And we read this update and it was in line with expectations. It wasn't a profit warning at all. And they said the Q3 last year was exceptionally strong. I think there was some factor maybe connected with building up stock levels or something, and that unwinding, something like that. But we think it's firing on all cylinders. It's a really good business. So we were totally perplexed yesterday why it fell 15%, but it has had a very good run. And I think, again, it's just this thing where you have twitchy holders who, if it's not ahead of expectations, maybe they just ditch on the opening bell. I don't know. It's down another 7% today.
Yeah.
It just doesn't make sense to me, unless one of the premium brokers has put out some reduced forecasts. But I think Cottony Rebel said on Twitter, somebody sent me a photo, a picture of it. He said that Peel Hunt apparently have increased their price target by about 10%. So no, we're scratching our heads on this. We think this sell-off, based on what we know, there could be information we don't know. We think this looks like maybe a little bit of a buying opportunity. So what's your view, Paul?
Yeah, I actually did speak to the management team last week.
Sorry, I was meant to be on that, but I was I wasn't feeling too good.
I'll tell you, these guys are super energized. I mean, Rowan and Cox, wow, that guy is committed and hungry to get this business flying. And they make better margins on the industrial side, the aerospace and the space side of their supercritical foams than they do on their on their midsoles. But basically, this goes into the actual soles of the shoes, for things like with Nike, with the running, rather than actually the insoles. It's the midsole part of it. And that's. I think that joint venture will do very well in the in Vietnam. With those. But the real margins are in the aerospace and defense and essentially what it does. They're obviously the supercritical foam is highly durable, heat resistant, flame retardant. And basically very lightweight and very durable, and therefore you can charge a decent price for it in specific applications. And I think it will do. I think they're actually selling it to people like SpaceX actually in their rockets.
Interesting.
So
that would make sense. Lightweight and fire retardant.
And that's going to be the stuff that's really going to move the dial, I think. And I wouldn't be surprised also at the ultimate. Eventually they decide to. Sell their manufacturing arm, particularly the one for the shoes and stuff out in Vietnam, and then become just a brand and an IP and license that one out, because I think that will release a lot of capital and become a capital light business. But anyway, I'm with you. I think it was I think they've done really well this year, and I think the key is to look at it on a year-to-date basis rather than sort of like get ultra worried on the slight flatness and decline in
Q3. Exactly, and it was it was in the forecast because it was in line. I think even slightly ahead of the forecast for the full year. But why them? I mean, you've now had a 20% sell-off, and it's back to where it was in August. Now, maybe it got a bit ahead of itself. I think that's the other thing. But maybe it's now overshooting in the other way. You're on a forward PE of 12, very modest net debt, well-invested factories. They did a big CapEx program over about the last 5 years. I mean, bears do say, look, this is a very capital-intensive business, which is a fair point. It is. It's got factories with lots of specialist equipment in it because it makes specialist products, But I think this Vietnam deal looks interesting. It's quite big, and the partner has invested quite a lot for a minority stake in it, and being right on the doorstep to the big Nike factories. There could be good upside on that, couldn't there, in terms of volumes? So we like it. I don't hold any personally, so I'm not talking my own book, but I do think this might be a bit of a buying opportunity. But we don't.
My guess, total guess, and I didn't discuss this at all with the management, will be 2027, 2028, when they actually get that factory commissioned and they start making, millions of sort of midsoles for Nike from that facility. They'll sell the facility to their partner. They'll pick the whole lot because they want to basically make sure that the science and the technology works and the processes works. Once you've done that, you've de-risked it, and the customer's delighted. Much easier then to finance. So that'll be my take.
That's an interesting angle on it. I do like it. It looks very interesting. It's one of those things where, again, you're getting a nice bargain basement price on the current performance, and there could be significant upside on it. So interesting.
Good. Let's move sectors. We've got Stephen Griffiths. He's asking about Focusrite, which does sort of like professional high-end audio and visual equipment I think they do for content creation and also for live events, big concerts and stuff. Came out with a inline statement, but it does seem as though it's turned a corner. Is there one of these Cockney Rebel bowls on the chart now?
Well, that's what I said in my report yesterday or the day before when we covered this. I said, that looks like suspiciously like a bowl on the chart to me. And of course, Cockney Rebels, Richard Crowe, he's a brilliant trader, and he's popularized this concept of the bowl. Which is great. And my colleague Dave always writes about music-related stuff because he's actually a semi-professional musician, a very talented guy, and he uses Focusrite equipment, and he absolutely raves about it. And he said back in April when they were down at about £1.40, £1.50, look, it's way too cheap, and it's probably my top share pick. So he's done very well about that. I was a bit more skeptical. at the time, but Dave's view has prevailed, and it's risen. What's that? Over about 60% since the April lows.
Yeah.
And no, we think it's very good. Dave drilled into the numbers yesterday or the day before, whenever it last reported, and he talked me around. It's good. We think this has got legs up to maybe £3.50 with a bit of patience. I would flag that they do capitalize a huge amount of development spending, so they have to run to stay ahead of the competition. But the brand name in the products, and they had big disruption over the COVID era. So we're pretty bullish on this. We think it's over there, and the balance sheet has rebalanced now. They did have excessive inventories. That's now normalized, so it looks back on track. Yeah, we think it's good.
Yeah, I mean, they capitalize. Their EBIT margins are still 9.5%, but even on a down market. So and that's after the internal amortization, not the acquisition amortization. So,
I suppose the main reason I flag it is because where you've got very heavy capitalized development spend, you've got to ignore EBITDA. That's the main thing. But you're quite right. Operating profit should be a fairer number to use. Yeah.
They seem to be the go-to provider, don't they, for all things If you want the first class, best class audio visual stuff for these content, these are the guys that the industry experts go to, I think.
Yeah, definitely. I mean, Dave, my colleague, he actually emailed me an audio file of him using the Focusrite equipment. And I said, let's put that in the report, but he didn't reply, so I think that was a no. But it was crystal clear. The sound was. And my brother's a musician and his wife as well. They said the same. It's the market leader Focusrite. And it's bought other brands as well, complementary brands. And the founder, I think still, Dudderidge, still owns about a quarter of the equity. So I think he might have retired, but I love it when a founder keeps the bulk of their stake, even though they're no longer running the business. That to me says, they've really got faith in it long term. So we like it. We like it. Focusrite.
Yeah. Important question from Drew asking about: have you ever found a decent cup of tea and Malta yet at all?
No. Oh, Twinings is the best breakfast tea. Was the best.
Is it? Okay. Yeah. Right. Okay. Then we got SE81. He's asking about Trainline, which is basically the ticket broker for all things train in the UK and internationally. I think it's looking for growth in corporate land, into corporate selling tickets. And it's also moving into Europe. And it came out, I think it was an inline sales figure trading update, but increasing the profits, I think. Their profit line was better.
We wrote
go on.
Well, my colleague John wrote a section on this today. It's good that the readers are picking on things that we've actually written about. Pure luck. Paul doesn't tell me what the questions are about. H1 results to August out today. You're quite right. Revenue was only up 2%, but operating profit was up 38%. So I said to John when I was reviewing it, what you've got to explain what caused that. He said it's benefits from cost cuttings, offsetting a cut in the commission rates, which is quite surprising. And there was quite a big reduction in share-based payments, down from 11 million to 5 million. So that is those are the factors that gave this a big jump in profit. Looks good value. P only about 12, but the headwind apparently is from Project Oval, which is TfL's contactless payment thing. So it does have some headwinds and some potential risks. Wasn't there something for GB Rail as well that might possibly?
Yes.
Yeah. So we think that we're moderately positive because it is cheap now. There's no doubt on a PE basis, but you do have to, and it does very big share buybacks. Balance sheet's not the best, but it's negative. But it's priced as a value share. So you've got to you've really got to do much more detailed research to decide whether other industry players are going to chip away at its profits or whether it's I mean, the figures look very resilient, didn't they, today? So yeah, we based on the current information, we quite like it, but we're not predicting what's going to happen in future. We just don't know.
You've got to predict what's happening in the future.
No, we just do desktop reviews as of now, and then the readers have to do the clever bit. And we're covering 800 companies. I mean, we can't.
Yeah, I would be. The reason why I'd be cautious, okay? Just think what might happen in 5 years' time with AI, right? You put into your mobile and you say, "Get me a ticket across Europe, the cheapest way." Bang, straight through. Does it need a ticket broker to do it for you? The answer to that is no, unless the Trainline system powers that engine, which is done by AI, which is possible, but I suspect it won't, because there'll be so many other things like the GB. I don't know anyway. I just think the whole purchasing and procurement of tickets is going to be thrown into the air literally in the next 5 years. I think everything being procured as for consumers is going to be really, and you've got to become the dominant, the number one. They are the number one. They're there to be knocked off. But I think with the power going into these portals, I mean, ChatGPT are doing their own Atlas portal, which is coming out. They're basically their web browsers they're coming out with. Gemini is going to do the same. You can just imagine, can't you? Just basically, if you're a business person or a consumer, you just say, okay, I want to get a train to Paris. Get me the cheapest one. I don't want to pay a fee at these times. It'll just do it, and it'll book it all the way through. So I don't know. I would be cautious at the best, to be perfectly honest.
Yeah, well, I suppose that's what the market is pricing in, isn't it? In a way, you would expect something with these sort of metrics to be £3 to £4 a share, but it's actually what, £2.68 a share. So yeah, the market is definitely priced in some of those headwinds, hasn't it? So but yeah, I honestly have no idea what the future holds for it. That's why I'm not interested in holding the shares.
Okay, good. Well, let's move sectors. We've got animal feed and stuff, all things animal. We've got Zuluk and Gary Bean Carrot both asking about Empariio, which basically does sort of specialist natural ingredients that help, I think, the gut and digestive system of animals. And they bought this really excellent acquisition, I think, in the States that does this sort of like capsule pill type, which will put more medicines into the bellies of anyway, the shares have done very well. What's your latest view on Empariio?
I don't think we've had any recent news on it. The last news I've got was the H1 results on 10th of September. We've been positive to moderately positive on Anpario. 6 times this year we've looked at it. We did bellyache about the management reward schemes, but we've flogged that horse. We don't need to remind people, go into all the detail about it. It is worth looking at. It's doing well. It's, as you say, quite a niche business, sound balance sheet. What's the current share price? Oh, 484. Yeah, it's similar to it hasn't changed much in price. It's held on to the gains recently. So yeah, but I mean, the short version is we think it looks interesting. Quite a nice business, I think. How about you, Paul? I think you quite like this one too.
I like it. I would say the share prices, I mean, the business is definitely doing better.
Yeah.
I would say, is somebody accumulating there? That smells to me, there's a shortage of supply of shares. And I don't know whether somebody is thinking about running a number on these, but hey, I don't know. To go up that strongly, consistently for an animal feeds business says that's more than just luck.
Yeah. I mean, it is trading well. Looking at the stats here on ShareScope, forward PE is only 15 times PE, and it's got a net cash balance sheet. So, despite the shares going up quite a lot, it still looks actually quite moderately priced to me. So I think this one's worth a close look. And have you seen the dividend track record on this, Paul? The yield is not particularly high, but it's very, very impressive. Since 2009, the divvies have gone up every year, even through the pandemic. That's pretty good going, isn't it?
Yeah. Now, I wonder whether the management team are looking, asking for offers behind the scenes.
Could be. Yeah, I mean, somebody could put the bog standard 30% premium on it, and they'd only have to pay 20 times earnings. So and obviously a vast market, isn't it? Yeah. So if these products, if they can really get they must be just scratching the surface of the potential market size. So yeah, I think it looks quite good.
Yeah, total speculation anyway, but I would not be surprised if we're talking about that in our M&A section in forward editions of this program. But let's wait and see. Okay,
Yeah.
we've got who was asking about Smith's News, or I can't remember. Who was it? It was actually okay. We've got somebody's asking about. I can't find it again. About Smith's News, which is basically a distributor of magazines and newspapers. That's about 90% of its revenues in the UK, and then the other 10 they're trying to develop new verticals to deliver things like I think it's engineer tools and cards and collectibles and anything else, and recyclables, anything they can else they use their vans to be able to generate. But the shares have responded really well this week on a positive trading update. What's your latest on it anyway?
We reviewed this yesterday. I think it was very good results, as you say. The earnings per share, it's a cigar butt stock. We all know that. It's got this, as you say, distribution network of self-employed drivers who distribute newspapers and magazines. Mainly, that's the overwhelming bulk of the business. Now, you've got stating the obvious here, that's a dying business. And I know this makes me very unpopular when I point this out to people, that I think you're getting close to a cliff edge where print in particular. I mean, I had a meeting with a very, very senior publisher, director of one of the UK's largest publishing companies recently, and I was really shocked when we were talking about print. He said, "Forget print; it's dead." And I thought, "Bloody hell!" So this is the problem, and they've managed. The volumes have been dropping and dropping and dropping, but they've been offset with huge cover price rises. So if you look at the price of the Financial Times now, something it's like £5 or something. That might be more. Well, you can't keep pushing that up. Magazines, again, are very expensive now. So I fully appreciate the numbers look amazing. PE of 6, you've got I think 8% standard divvies plus another 5% special divvies. So the numbers look fantastic, but just be aware there's I would say almost certainty this is going to just hit a brick wall at some point, not in the next year, but maybe 2-3 years out. The print sector is likely to just collapse. And for that reason, I'd be really careful about this. I know people are going to hate me for saying this, but I'm just giving my honest opinion.
So why have the shares more than doubled over the last 5 years? Because if it's a melting ice cube and it's dying, it's on a cliff edge, the shares are ignoring what you're saying there, Paul. They've gone the other way.
No. I've been bullish on it. I've been bullish on it. From the turnaround from 20-30p, I was bullish on it. Because I spoke to management a couple of times and they explained actually we can downsize all the costs and maintain the profits at 10p a share. So up to about 40-50p, I was bullish on it. But I just think you're now in a position where the clock is ticking. They're already down to the minimum number of depots. They've said publicly, look, we can't cut much more. We've cut it to the bone now. And you've got this cliff edge for demand. Now, if they can come up with something really material to utilize the network, then, it could be great. You could double your money or more. But so far, I don't think there's anything meaningful. There's a recycling thing they're doing, isn't there? But it's just, my main worry is just that core business that I think is edging closer to collapse. I think it should be on a PE of 3, not 6. So, but just my personal opinion, could be wrong. But
Okay, we've got Paul the Parrot. Just a quickie. His general observation that he's seeing a lot of small caps drifting down in between news. Do you any thoughts on that at all, Paul? What if it is happening? What's the reason? Do you reckon?
I think he's absolutely right. I'm seeing the same as well. What I would say, it's all down to lack of liquidity. And you've got, as you say, forced sellers being the open-ended investment funds. Very much the chap at George, I think it was, at a micro fund thing, a listed thing. He was saying that yesterday in a very good webinar. He just said it's a big issue. These open-ended funds are in a sort of death spiral where they have to keep selling to meet redemptions. So that issue is not over. you've mentioned it previously as well, that we've still got a big overhang from sellers in some stocks, not all. So what was the question again? It was about drifting down.
Drifting down. I've just got there's a share there, Traxis, we've talked about a lot, which does like the software and hardware. It hasn't reported or made any announcements for some time, and you can just see how that's gone down. Gone down from £5.
That's why I feel, and I've been saying this in my podcast for a long time now, I feel the best strategy right now is when you get these powerful rallies, and things often overshoot on the upside on RNSs, you nearly always see people selling into that. So I think this is a trader's market. It's a profit taker's market. You know, I don't think it's necessarily a buy and hold forever market. I think people can definitely enhance their returns by just top slicing or ditching things after an inexplicably large move up, and then you just wait for it to drift and buy them back. So traders market, profit takers market.
Good. Okay, let's move sectors. We've got healthcare. We've got Andy 22055 asking about Spire Healthcare. I mean, I actually own this one, and he's asking whether any worries about the share price dropping of late.
I don't know anything on this, Paul. You give your view. You know it better than me.
Yeah, I mean, I've owned this one now for about 18 months, and let me just put the chart on. This is the UK's #1 private hospital. There is absolutely no problem. There's no worry in terms of the fundamentals of this business. We've got about 7.5 million people still on waiting lists. The NHS is contracting a lot of that volume out to Spire Healthcare and hips and knees. Their facilities are absolutely rammed, I can promise you. The other thing is that the board have done a strategic review, or they've been forced into it and put the company up for sale. So it's drifting down simply because people are using it as a bit of liquidity, as a bit of an ATM. I personally would say, I am absolutely not selling the shares. I think this one will get taken out probably around about March next year, because this is quite a big business with a number of facilities. There'll be a significant amount of due diligence. There'll be a lot of there'll be a reasonable number of interested parties, certainly from private equity, in terms of the healthcare infrastructure funds. And there's also there's a trade buyer in India as well. So yes, if you bought at a low and you want to take a bit of profit out before Christmas, then that makes a bit of sense. As always, personally, I'm not taking profit out. I'm running with this, and I think this will go over £3 in March, April time next year, because I think they'll conclude it, and clearly the shareholders want to sell it. Even the biggest one, certainly, as I understand, certainly does, which is in the Middle East, Medi Clinic. I understand that's about nearly 29.9%. So if the biggest shareholders want to do it, then I'll be stunned if there isn't a clearing price on it. And as long as it starts with a 3, I'm pretty sure they'll accept, and that wouldn't be expensive, because the actual value, the actual land value is about, I think it's about £3 actually on it. So, you're paying net assets on it.
You were spot on with this one. I remember when we talked about it after that big plunge, you were saying, no, the freeholds are worth way more than book value, blah, blah. The Harwood boys went into it, and they get a lot more right than they get wrong. No, you called that one spot on, Paul. Just in the same sector, but a minnow, there were recently very good figures update from One Health Group. OHGR. I have got a small position in this, but I'm looking to top this one up. Have a look at this, Paul, because it's 32 million market cap, 10 million net cash, genuinely surplus net cash, a third of the market cap. Owner managed by, it's a recent float, owner managed by a surgeon who is looking to address, again, opening private surgical units. And they're expanding. They've got one in the build stage, fully funded to build these new facilities, and they're already profitable, making nice, genuine profits with a good growth runway. I think it's very interesting. But as I say, I've only dipped my toe in just with a starter size position. But have a look at that one, Paul. I think you'll be pleasantly surprised. We reported on it recently, and I was very pleased with the update. Actually, I'm just trying to find my notes. I think it's actually quite cheap. On a PE basis. Here we are, 27th of October, that's recently. H1 trading update was in line. It's worth a look, I think, because being so small, it can scale up. You see in percentage terms, much more than a bigger company. I think that's a nice one to have a look at.
Yeah, no, I haven't looked at it, and the reason why I decided to go with Spire is because of the economies of scale. Because there's a big networking effects on this. You don't get paid well at the NHS to do these hips, and you have to basically you only get the benefits by effectively really nailing all the efficiencies and getting everything singing and dancing on it. Now, if you've got a new,
you say that, but OHGR probably has a. I mean, it's making a 6, 7, 8% EBITDA margin.
Yeah, but the point is that they haven't got the facilities. If they have the facilities, you've got to get the utilization up there. It's a greater risk. And so they're just doing pass-through at the moment. They're basically employing surgeons to do facilities in existing hospitals, whether it's private or in the NHS, doing operations, and they're clipping it. Now, if they've got a facility, then it increases it. Don't get me wrong. I don't think it's a bad choice. I think it's a great sector, okay? But you asked me why I went for Spire, and I went for Spire because of the scale effect of it.
Yeah, I understand. That makes sense. The only thing I would say is that OHGR is building its own facilities. So you've got that growth pathway and better margins. But its margins are good. Yeah, it's making good margins. I think it's definitely worth a fresh look after the recent trading update, which was very, very good, I think.
Yeah. Okay, good. Let's move sectors. Let's go to financials or trading. We've got Steve Waters asking about TP ICAP, which is the interdealer broker. Basically, I think it's very, very, very cheap, but they must have come out with something today. The shares are down 5%. Was it a trading update or something?
Yeah, it was a 9-month trading update to September. Revenue up 7%. That's just detail. It said it was comfortable with full year expectations. So subject to FX. I'm not entirely sure why it dropped 7%. This is TCAP, TCAP is the ticker. It's got a really good balance sheet. Wow, 867 million net cash. Some of that might be clients' cash, maybe, I don't know. But this looks because the net tangible asset value is only 263. So that's timing differences. Most of the cash. We think it's good value. You've got a 6% dividend yield, plus it's doing buybacks. Plenty of cash and a PE of 8. So brokers don't tend to go for PEs much above 10 or 12, do they? That is usually the peak. You've got IG Index, you've got CMC Markets. They're all on PEs around about 10. But yeah, I've got to say, TCAP, I'm not an expert on it by any means. TP ICAP is the name. It looks quite attractive to me. I would agree. I mean, I think we've had recent volatility. I mean, you've had sterling weakening against the euro and the dollar, so that should help them on that volatility. They're the biggest in the world on interest rate futures, and we know the yields and the bonds have all gone down. Prices have gone up, so that means that they'll have made probably done pretty well on that sort of trading as people sort of like hedge off their positions. And then the other thing I'd say, which would help them, is because the dollar's strengthened. Then they're reporting sterling. About, I think, 2/3 of their revenues are in dollar denominated. So with the stronger dollar, just the translation is going to help them. So all in all, unless there's something they said in that statement about the balance sheet, they've got an exposure, then I would say that's I mean, they should be doing well in volatility. These guys do well in volatility, and if the dollar's strengthening, they'll do well as well. So. Yeah, I mean, it's said comfortable with full year expectations, as I say. Do we know, Paul? I don't know this business very well at all. I mean, it used to be insanely cheap. I remember a few years ago. I mean, just you looked at it and thought, what the hell? Do we know, do they take any sort of any risk on their own book? Or is it just a pass-through type of thing? Do we know?
It tends to be just a pass-through, but they do take... Remember they do this for serious... guys, professionals, the hedge funds. If you get an explosion in a hedge fund, then it has tremors into TP ICAP, because they're basically left holding the bag.
So you're thinking more counterparty risk rather than actual book risk.
Yes, that's it. They offset it, but to pass it through, they've got to have both sides of the transaction working.
I see. Yes. Okay. Yeah, interesting. So it does look good value, doesn't it? Yeah, for sure.
Yeah, good. Okay, right. Let's just do one more. Let's go for. Oh yes, let's go. Tim. He's asking about. It's been an absolute rocket ship. Ceres Power. Okay. Now this is basically a fuel cell developer, and they can use it for hydrogen as well. but it seems as though the investment thesis has changed materially, because the shares have absolutely gone to the moon, and
They have, haven't they?
it appears to me, and I'd love to hear your thoughts, and I'm sure sure the guy would do as well. But it appears to me that because there's a difficulty in procuring effectively natural gas turbines for power, they can't. It's all booked out to 2030 apparently. Then these guys, their solid oxide fuel cells allow you to convert natural gas into electricity, and therefore you can use them for things like data centers. So I think the investment case is totally changing on this one. But anyway, what's your take on it? Because the shares actually have just gone to the moon. They've rocketed.
They are doing amazingly well. Yeah, it crops up on my radar regularly on the sort of percentage market movers. Unfortunately, because my my website is focused on value and GARP investing, we've covered it 4 times this year, but we just give no opinion on it, because we can't value it. It's impossible to value for a value investing column. But so we just flag the news. All I can say is it's heavily loss-making and cash burning. But the market obviously still got, I think, 3 years runway of cash. That was back in March. So it's got enough cash runway, it seems. Obviously, people, I mean, it's a huge market cap now, isn't it? Really quite 750 odd, nearly. So clearly the market has latched onto the potential for this and the technology. And I think there was an announcement today, wasn't there, about something to do with was it a Chinese manufacturing agreement or something? So it's totally outside my scope. So I just declined to give an opinion on it, because it's not the sort of thing we analyze. But look at that share price chart, well done to you 6-bag people who backed that, who took a punt on it earlier this year. So I think, very specialist. You'd need to understand the technology and the markets and everything, which I don't. So no opinion, I'm afraid. Have you looked into it, Paul?
Yeah, I mean, I think the market up to April wrongly put this into the bag of it's basically a fuel cell for creating green hydrogen, which everybody thinks, they're disappointing in hydrogen, it's taking a long time. But actually, the technology is more applicable now in terms of converting natural gas, which is plentiful, into electricity and putting it next to data centers and generating power from all the spare natural gas they've got into the States and all around the world, because you can't get a gas turbine. You can't. But if you went to GE and to all the other gas turbine manufacturers, they're just booked out. There's no availability. So if you want electricity, if you can't connect it to the grid, which is more than likely, and you want to do a data center before 2030, then the only way of doing it is to get power from somewhere. And I think that's what the market is showing. And you're right. I mean, I was looking at the numbers. It's over 11 times sales now for a no-profit company. But that says to me is that, clearly there's somebody building a huge position in it.
I know it sounds very exciting, and it's up 20% just today. As I say, totally outside of the scope of what I do or what I understand, but it does chime with a recent press article I saw about, I think it was both Blackstone and BlackRock said that the US is facing a electricity crisis, that it's got this AI boom going on, mainly in America, the huge data centers and vast requirement for electricity, and they won't be able to produce enough electricity. So this sounds like it's very much in that potentially lucrative space, doesn't it? So it's not the sort of thing I would punt on, because I just haven't got the knowledge, but it does sound very interesting, exciting.
Okay, right. Okay, the final one, we've got Derek. He's asking about Kromek, which I don't know if you own at all. It's basically a company that does sort of like I think it's some specialist image scanning material that goes into things like MRIs and into the healthcare sector. But also they use it for sort of like what's it called, nuclear sort of smart devices into the States and stuff. And he's asking, what's your latest view on it? The shares have sort of stabilized and gone up recently.
They have, actually. This has been an unsung hero of my geared account
Okay.
recently. Funnily enough, it's your fault I own these, Paul.
Why is that?
Well, I was going for a walk in Gozo through a sort of dusty village where there was absolutely nothing there. And I was listening to one of your brilliant fund manager podcasts. This was, I think, about 6 months ago.
Okay.
And one of your fund managers gave a brilliant case for Kromek and said, look, it's been an absolute dog historically, but they got this 36 million, I think it was, dollars out of Siemens just out of the blue, and they got nearly all the cash up front. And this is when the market cap was about 20 or 30 million. And he said, and that was for their kind of old generation software, technology. He said it's got the potential for much bigger, and it wasn't exclusive. So he said the technology is worth multiples of the current price, and I love that, where you get something completely under the radar that just wins a massive contract. So that was why I bought them, and it's usefully up. It's about 50% up since that conversation. So somebody's accumulating here as well. It put out quite a reasonably good update recently. I think it was. It was only about 2 or 3 weeks ago, and it just seems to creep up a bit every day. So somebody, I think, is accumulating that stock. So as I say, deplorable track record, and I think management. Oh God, I watched a webinar with them. One of the worst I've ever seen. They're talking about doing M&A.
Oh wow, okay.
They haven't got any. They've barely got enough cash to continue operating. I thought they were on a different planet, the management.
Yeah,
okay. But I mean, what's your view, Paul?
I don't know whether this is going to be something a bit like Filtronic, okay, which disappointed perennially for 20. I know, for 20 years, and then they suddenly found an application that really they've been looking for forever, which was, for Filtronic's case, was obviously low orbit satellites, okay, on the base stations, because that had been a perennial underperformer, and then the shares have just gone to the moon. So it could do something like that. We could have an application that suddenly gets developed that actually this unique, I think it's CZT imaging material they use, which they have to make, which is quite working capital heavy to manufacture. You have to grow it from crystals, so it's actually quite a tough one to do. However, if they can actually find this application then it could do really, really well. But as I say, on that's the one. That's the bull case. The bear case is that it hasn't gone anywhere long term, and they've had great technology. Is it really going to find a home now? But you'd have to dig through all the past, basically all the technology, and look through the application areas to see whether it is. I would, to be perfectly honest, like you, I would like to see a bit of change on that board, given it's been there for ages. To basically, in some of the institutions, to bring somebody else on board to give it a bit of direction. But
somebody more commercial, I mean, I would emphasize I've only got a small position in this. It's not a conviction; it's a punt. Basically, for me,
But I haven't. But when I've said that, I haven't really followed it for some time, so I could be I'm probably out of date. But that would be my take on it. If an investor sees something that is really going to be valuable to use that CZT sort of imaging materials, then it could really do well, because there aren't that many companies who do it. I remember that, because it's quite an involved production process to grow those crystals. It takes like 6 months, I think, something like that.
Yeah, and I think they sold some of the existing fixed assets to Siemens as part of the deal, didn't they?
Okay, right.
I mean, I don't understand it at all. I mean, for me, it's a punt based on one thing only, which was the $36 million Siemens deal. And at the time, it was a market cap of about 30 million. That's the sole reason why I took a punt on it. So fingers crossed.
No, I think it was originally a spin out of Durham University, if I remember rightly. So a long time ago. Okay, well, we've been going at it now just over, nearly 80 minutes. So thanks everyone for your questions. Thanks again, Paul, for the terrific comments. I really hope you enjoy your cup of tea in Malta. But
I got to track down some Yorkshire tea bags. I should have put some in my luggage, but I didn't.
Well, I think you might want to treat yourself to something a little bit stronger tonight, given it's your anniversary of.
Well, I've already started, as the sharp-eyed would have noticed.
Okay. Well, thanks, guys. Same time, same place next week.
Yeah, loved it. Thanks, Paul. Thanks, everyone.